I don't know. It might be funny. Hey, welcome
Okay.
everybody. Glad that you are joining us this afternoon or this evening, wherever you're calling from. We had close to 100 people register for this event today. So we're going to give it a minute or so and see who logs on, joins us. Could be two or three people, could be 50. So I just want to give people a little bit of time and be respectful for anybody who might be running a minute late. You know, uh, I know, Paul, you wanted to tell a joke, but one thing I always say that if you're on time, you're late. And I'm really grateful that all you guys were early today. So thanks for being here early. Thanks for being here on time. Appreciate it. Hey,
You bet.
everybody,
It's an honor to be
welcome.
here.
Glad that you are joining us here this afternoon or this evening, wherever you are calling in from. I know that we had quite a few people register. Want you to know that we have engaged the chat. So as we go through, if you have any questions, matter of fact, right now, if you would go ahead and say hi in the chat, say where you're from, let us know that you are alive out there. Wilson's calling in from Nigeria.
All
Uh,
right.
Good to see you, Wilson. But yeah, let us know where you're calling in from. Okay, Tampa, Florida, Irvine, California. That's great. Um, Little Rock, Arkansas. Holy cow. Another Tampa, Florida. That's great. It's good. It's good that people, Connecticut. So, geez, we got the East Coast represented, Midwest, overseas, Toronto, Canada. It's good. Chicago, Illinois. Great. Glad that you're joining us here today. All right, I'm going to get going without further delay because I know that we have a bunch of questions to get to today. As I mentioned, I'm really glad that you're joining us today. If you're joining us today as a passive investor looking for a place to put capital and be more intentional about that, we're looking to build more meaningful relationships with you. So you are definitely in the right room. The good news is we're not selling anything here today. So none of us have an offer. None of us have anything to offer you. We are here to bring you some content and some information, give you some perspectives maybe that you're looking for in where the market's at and what's going on in the world right now. I know we're not going to disappoint you this afternoon, but we're here to help you learn something new. So as the market keeps shifting and it's shifting quickly, and I'm seeing it shift again now, this is becoming a greater time to position yourself for your investments and your investments for tomorrow. We're living in a time where traditional paths to build wealth through stocks, savings accounts, bonds, even single family real estate are being challenged more and more. Investors are turning towards alternative investments, multifamily, crypto, other currencies out there, and are looking for cash flow, looking for tax advantages, and looking to build long-term wealth creation. But here's the truth. Great deals don't get done without great capital. And great capital doesn't come without trust, relationships, and good communication. And that's what I know all of us are going to bring to the table for you today. Um, and that's really what today's going to be about. Today, we're going to go beyond surface level conversations. We're going to dive into what it really takes to build trust with investors, communicate effectively before, during, and after deals, how to scale your capital and to deploy it in proper places or what might look like a proper place today, how to develop a mindset that's required to operate at a high level as an investor, as an operator. And to do that, I brought together 4 experts who are actively doing this at a high level. So I'm joined today by Jeff Beck. Jeff is filling in for Chad Coe, kind of a last minute change here. Chad had a little emergency come up. So Jeff, welcome. Karen Hall with UDirect, Travis Watts, and then Paul Moore. I'm going to give everybody a minute to introduce themselves as we get started here. But each of them brings a unique perspective from building investor relations and raising millions of dollars in capital to structuring deals, nurturing relationships, and scaling their platforms. These aren't just theorists. They are actually in the trenches doing, working, and operating with investors and navigating the same market conditions that we're all facing today. So my encouragement to you is this: lean in, take some notes. If you're driving, maybe pull over, take out a notepad. Most importantly, think about how you can apply what you hear today as you begin to deploy some capital as this market continues to change. Because at the end of the day, the business comes down to one thing, or a couple things, I should say: people, relationships, and trust. And if you can master those, or we can master those with you, you're going to win in this market. Today, all you need to do is answer one question: do you trust any of us? And do you think that any of us would be good stewards of your investment capital? So let's jump in and get started. I'm going to start with you, Karen. If you want to jump in, introduce yourself, tell people who you are and what you do.
Sure. Thanks so much, Mike, for the opportunity to be on the event today. Really excited. I'm the CEO and founder of UDirect IRA Services. We're celebrating our 17th year this month, and I've been in the self-directed space about 20 years now. And I've authored this book by Bigger Pockets called The Bigger Pockets Guide to Self-Directed IRAs. So what we do at UDirect is help people take their money from Wall Street and move it into Main Street into alternative assets. And that's what we do here.
Awesome. Thank you. And Karen and I have been friends for many, many years. And I remember when she first started UDirect. Jeff, why don't you jump in and say who you are, what you do?
Yeah, absolutely. My name is Jeff Beck. Thank you for having me. As Mike mentioned, I am filling in for Chad Coe today. He's actually my business partner. So we are financial advisors working out of a small boutique firm just north of Chicago, Illinois. So we primarily work with individuals and families. Our focus is often on retirement planning, investment management, and tax strategies. My particular kind of sweet spot and clientele is working with pre-retirees, people who are hoping to retire within the next 10 years. So they've been working for quite some time and looking to retire. I also do a lot with people transitioning from divorce, mainly those people who have not been really the financial spouse in their relationship. And then I also do quite a bit with young professional investors. So typically high income earners with young families who are looking to start building their long-term financial plan. Again, my name is Jeff Beck, and I work at Co Financial. Thanks for having me.
Welcome, Jeff. Thank you. And I know you're kind of be in the hot seat here a little bit today. So Travis, why don't you go ahead?
Sure, happy to. Travis Watts, been investing just individually in real estate about 17 years. In the last decade, I've been in private equity exclusively to invest in syndications and invest as a limited partner. And I consult with various companies in the syndication space to help them build educational content for investors. So that's really what my passion is. Also, like Karen, written a book on the subject, had many different podcasts that I've done over the years with Best Ever. And yeah, that's a little bit about me. So right now, my interest is in helping a Spartan Investment Group. They're a self-storage operator, and we're launching numerous initiatives over the education platform. So it's me in a nutshell.
Awesome. Thanks, Travis. Glad that you're here. Paul, how about you?
Hey, Paul Moore here. I sold my company in 1997, and about exactly a decade later, I found myself $2.5 million in debt because I wasn't really an investor. I was a speculator, made a ton of mistakes, launched the How to Lose Money Wealth Building podcast. And I think a few of you guys were on there. I know Mike was. And we had a good time doing that for years. I've written 3 books on real estate investing. We launched, after doing residential real estate for about 15 years, we launched Wellings Capital a little over a decade ago. We we have 8 funds that invest in self-storage, mobile home parks, light industrial, multifamily, and more. And so a really honor to be here, Mike.
Awesome. Thanks. I'm glad everybody's here. And for those of you that don't know me, I am Mike Morawski. I have been in the real estate space for about 30 years. I'm the Chief Investment Officer with Resilience Equity. And we basically buy multifamily apartments in specific markets around the country. We raise capital from private individuals and we share in the profits in those. I also am an author as Karen. I wrote a book, my last book I wrote, this the third one, Multifamily Investment Secrets, Your Explosive Guide to Wealth in Multifamily Real Estate. And I also do a little bit of coaching with specific individuals who are looking to scale their multifamily portfolio. So welcome everybody. Glad that you're here. Let's jump into some questions. So, I know right now with rates where they are, with uncertainty in the market, is this actually a good time to be investing either traditionally or in real estate? And we don't need to be even specific about real estate unless you have a passion or feel that there is an asset class that you should be specific about. So, Paul, why don't we start with you?
Yeah, I'm going to give a weird answer. Warren Buffett and Charlie Munger worked together for about 60 years till Charlie passed away a few years ago. And they claim they never had a single conversation about the economy when deciding to invest or divest. And I thought that can't be right. But they said no, that what they do is they look for 3 things. They look for durable asset types with competent managers bought with properties or assets bought with high intrinsic value, meaning that Warren said, price is what you pay, value is what you get. So with built-in intrinsic value. And they said if they did that, they could do that well. And if they held long-term, Buffett again said, my ideal holding time is forever, they could do well in any economy. And so I'll just throw out that thought that if you can find those 3 things, a great asset class, a great durable asset, run by capable managers with high intrinsic value built in the day you buy, you can probably do well in this economy or any economy. And I would add, probably shouldn't use risky floating rate debt. I think some of us found that out.
Yeah, that's for sure. How about you, Jeff? What are you seeing with investors right now?
Yeah, I definitely agree with a lot of what Paul just shared there. One of my favorite quotes I talk about with our clients is time in the market is more important than timing the market. For a majority of our clients, if not all of our clients, we really are focused on long-term investing. And so, kind of again to Paul's point, regardless of what the market looks like, right? Even if we are seeing record highs in the stock market, right? We understand that some things can be overpriced, things are at record highs. But if we are planning for the long term, right, it is about time in the market. So one thing I guess I would kind of incorporate as well to that is utilizing dollar cost averaging with our clients at this time. A lot of our clients are doing stuff like this without realizing it. But when we are contributing to 401k plans, retirement plans, when we're adding regularly to an investment strategy, right, we're dollar cost averaging over time. So our average get in price is at different points. And that really is a great strategy to use long term. So even with some clients, if they have, maybe a chunk of capital that they're looking to invest, we can still deploy a strategy of kind of dollar cost averaging that money into the market. And I think that's one way for us to kind of diversify our risk a little bit, even though we are seeing the market, really at all-time highs right now.
Yeah, interesting. Thank you. How about you, Travis?
Sure. Yeah. A couple of things to piggyback off both speakers so far. So the DCA, the dollar cost average, has always been a philosophy of mine too. I mean, go back the last decade, any podcast I've ever done, I talk about I'm buying every year, and I really have every single year. I'm investing. I'm not one to sit out. I learned that early through others who had sat out for an extended period, and then just sort of looking at my naive self not sitting out in the markets and just seeing kind of what those results were. And it's just a personal preference. I'm not saying do or don't, but I've continued to buy. And what's funny is, something that Paul alluded to is, floating rate debt and whatnot, which I invested in some deals that had floating rate. I invested in some deals that had fixed rate. I invested in some assets that had no debt. It was kind of all across the board. What's ironic is going through the last 5 years, as we know, many of these syndications kind of, went south, especially with floating rate debt. I've got investments from 2019, 2020 that have continued to increase distros ever since and through today. We're not planning on selling. Our debt is secured. We have a low LTV. We're amortizing. I mean, so there's always a time and place and a structure is my point. So rather than getting scared and saying, whatever, maybe the stock market is, at all-time highs. I do think DCAing a little bit there, but I'm a distressed investor. I've always looked at, what's on sale. That's a simple way to look at it, right? So if I look around macro level and I'm like, all right, S&P and NASDAQ are at all-time highs, commercials 30% off, Bitcoin's 50% off, right? I'm looking at more of those distressed sectors and not trying to time the exact bottoms, but just saying, hey, I see more value potentially there than I do over here. And that's just simply how I look at it.
Yeah. Interesting. Hey, Karin, I want to twist this up a little bit. And you come from the side of the market where investors are investing through you, right?
Yes.
Where are you seeing capital going today? Where
it's, yeah.
Go ahead.
Sure. I mean, the number one asset class for our industry for a long time has been private placements, the Reg D offering, for example, where there's that describes the structure of the investment, but not the underlying asset. So the underlying asset for a long time was multifamily. Talk about, the adjustable debt and what happened there. I mean, that was a situation, but we've seen a lot of black swans where things happen in the market that you don't expect and it impacts investors. But still, even still, it's the private placement that's the number one asset class for us. Now, the number two asset class, at least say for over 2025, as you might imagine, the most profitable was metals. We saw metals shoot the heck up in 2025, and we'll see it's probably not that this year. But a third would be notes, buying performing and non-performing debt, and also being the lender. Your IRA could be the bank and lend money to other people. So those are some of the asset classes that our account holders invest in, the top three.
Yeah, it's interesting about metals. I had an investor, maybe 10 months ago who was going to put a big chunk in a real estate offering that we had. And on a Friday, he was going to take care of his paperwork and going to set his transfer up. And on Sunday called me and said, hey, listen, I made a decision. I'm going to put all my money in silver. About 6 months later, got a phone call from him, said, I made a big mistake. So, I think it's, there's some investments you can invest in that there's certainty, and there's some that are very much more speculative,
Well, then the more to that too. I mean, like real estate, when you invest in real estate, at least it's an asset that can throw off income. Metals are like a hedge against inflation is what the most common thing is to say about metals, but it doesn't throw off any income. So you buy it and hold it, for Armageddon or something, or hoping that it increases. They call me a silver stacker because I get those, little containers of silver coins. And I started doing that a long time ago when I got in the industry, and I bought silver at $13 an ounce. So I was pretty happy, when it went way up. So that's not bad. It's again, the buy and hold forever was kind of that strategy. But yeah, so income producing assets, that seems like there's more upside.
Yeah. That's kind of what Jeff was mentioning, sort of the buy and hold forever strategy. And there's a lot to be said for that with real estate as well. But okay, so, with market conditions where they are, where are you seeing, or what type of investor sentiment are you seeing out there today? Where's, what are investors saying? What are they doing? What is their mentality that you're seeing from those investors? Jeff, why don't we start with you?
Yeah. I think for our clients that are a little closer to retiring, right? I would guess I would kind of look at our clients in three different phases. The ones who are already retired, the ones who are very close to retiring, and then the ones that have maybe 20 or 30 plus years until retirement. I think the ones that are that far away, they're not even thinking twice about it. We want to sit down and review the portfolio, and then they got too much going on. It's just let things continue to go and evolve. They really have a good mindset of again, kind of that long term buy and hold type of strategy. We might make some little tweaks here and there, but really not a whole lot of concern for a lot of those younger clients we are working with. I think similarly, our clients that have retired are really in good shape. The market has been so strong the past 10 plus years. For a lot of our clients that have retired in the last 10 years, they've seen their portfolio, they're taking distributions and have still seen their portfolios grow, X amount of times. And so, I think they're in really a good place as well. I would say over the last couple of years, we just continue to make sure that we're staying true to what our risk tolerance was, right? What we want our asset allocation. I think that's the most important conversation with them. If we were looking to be 60-40 between equities and fixed income, just because the market's running up and it's 70-30 now, we don't leave it there. We get back to what our plan was to make sure that we kind of are taking the emotions out of things. So the biggest concern I would say are those clients that are looking to retire probably within the next 5 years. They're somewhere between, tomorrow and 5 years, where we are looking at things a little bit more. And do we need to get to a point where we want to be a little bit more conservative because we don't want to see an extreme amount of volatility right before they go into retirement, right? That could drastically change their plan and maybe how we go into retirement. So those clients are the ones that we're probably talking to a little bit more often, making sure that we have a good plan in place and that we're kind of watching things a little bit closer. But again, the younger clients, the ones who have been retired for quite some time, I feel like they're really pretty confident in what we're doing and the plan that we have in place for them.
Yeah. How about you, Paul? Any thoughts on that?
Yeah, about 73 or 74%, oddly enough, for 2 years in a row of our investors are repeat investors. And we were celebrating that. And then we realized, wait a minute, that means we're not getting new investors. And I think part of the problem is a lot of folks are scared. A lot of people who thought that, hey, I'm done with the stock market. I'm going to throw all my money in real estate. A lot of them tried first to flip houses on the side. And some of them were busy doctors or professionals who realized, it wasn't worth the time, hassle, money, and headaches and toilets. And anyway, then they went into passive investing and they found out that it wasn't what they thought. And they watched their friends double their money in the stock market while they lost money, or they've got money locked up in deals and they haven't got the return of principal. They haven't got the profits they thought. So they're a little, they're pretty scared. And some of them say they'd like to invest, but their money's locked up in other deals they're hoping will survive. And so, yeah, I mean, it's a tough time. It's
Yeah.
a tough time. And I think a lot of it, obviously anybody on here probably knows a lot of it went back to what happened, and, what was it? There 11 rate hikes in 16 months starting in 2022. And that wasn't the problem, to be clear. That just exposed the problem. I wrote a book called The Perfect Investment about multifamily. And then I went on Bigger Pockets on it. I had a little show on Instagram Live and I was like, time out. It's not the perfect investment if you have to over leverage and overpay and assume the rents will go up 9% a year from now on and basically speculate. And so I think a lot of people realized that some of the syndicators took what could be a perfectly good investment and turned it into a speculation by doing some of those things. And I've done it myself in the past. So, I get it.
Yeah. And I think that's how we learn sometimes, is because of our own mistakes around it.
Yeah.
I'm going to kind of change this a little bit. So, we know interest rates are high. And there's this uncertainty in the market. Have investor expectations changed over the last 24 months? Karen, I want to start with you with that question.
Right. With the self-directed IRA, our account holders are choosing their own assets. So we're not always involved in that like decision-making process. And we're busier than ever with people investing in alternative assets. So I just think, but I like to speak to the decision-making process when somebody's looking at an asset, and it has to do with due diligence. You have to really understand so many, different aspects of it, not just investigating the market, but investigating the operator and investigating the terms and making sure you really understand the terms, not being surprised when you're not seeing, return by a certain point. But also, I forgot, Paul, I think it was you that was talking about that, passive assets aren't passive. And that's really, really true. Don't think that just because you're not swinging the hammer that you have a passive asset. Every single asset class is active, in the sense that you have to look at it. Are you being paid as agreed? You can't just sleep on this stuff. To be a good investor, you have to be, tending the garden, so to speak.
Yeah, for sure. How about you, Travis?
Yeah, just to speak to kind of sentiment, I kind of look at it as these tranches that we just went through. I know you said a couple years, but I'll go back to like 21, 22 in commercial was largely the peak, and largely because of what Paul pointed out with the rate hikes, the fastest and most aggressive, right, in 40 plus years. So we had all-time low rates, all-time high pricing. That's 21, 22. So that's your euphoric, blow off top, like many assets kind of went through, but real estate is so slow moving. 23, 24 was kind of that denial on the way down, right? No, it's not going to be that bad. Like, yeah, they're pausing distributions, maybe a capital call, it'll be fine. And then we really saw kind of the falling out through 24 and 25. And this is where people are handing the keys back to the banks, and where you're not able to refi. I mean, things really fell apart and continue to, frankly, in 26. But something to think about at this point is, if you go back to even the GFC, the Great Financial Crisis, and this last one that we went through, and anything prior, you have to look at kind of the time frames of, how long do we kind of sit near this bottoming out? It only lasts so long, historically speaking. Hopefully we're not in some new unprecedented, decade of nothing. But point is, we're probably closer to the recovery by far than we are further declines in commercial and whatnot, even if, by the way, they do decide to raise rates incrementally, a quarter point, a half point. I still think the vast majority of the ugliness is behind us. So again, back to kind of the dollar cost average thing, I'm more of a fan of that model, to Jeff's point, than to try to time and say with absolute certainty, like 26, is the bottom, or 25 was, or whatever. So that's my opinion.
Yeah, I think timing is a vast question, that's for sure. Hey, Jeff, what market indicators are you personally watching right now, and maybe even like encouraging investors to move money because of what's going on in the market?
Yeah, I think for us, obviously just looking at the stock market as a whole is a pretty good indicator of things. I think one of the biggest topics I'll just kind of jump into, mostly for us, is really kind of this AI bubble. I think it's just been talked about, almost ad nauseum to people. So I think kind of looking at certain AI stocks, looking at the NASDAQ as a whole, seeing kind of how that's operating, seeing how that's moving, looking at, P ratios within those types of companies. I think that's, something that's just being talked about a lot with our clients. So many of the, mutual funds, ETFs that we might be utilizing and not realizing it because of this run up. Some of these companies are such large holdings of these different funds that we might own, and people don't even necessarily realize it. So you might have this fund that's in 150 different holdings, but you have Nvidia and Amazon and Apple and a few of these that are taking up 30%, 40% of the pie. So I think that's something just interesting to look at that we're maybe having more conversations about as, we kind of talk about these cycles in the market historically. When there's that euphoria, when it's so good to, too good to be true, sometimes it can be, and maybe is there opportunities to make sure that we are further diversifying out of, one particular sector of the market. I think that's, some ways that we're looking at things right now. And again, big topic of conversation for us currently. I know there's some other big things, especially in real estate, we'd be looking at, but for us, that's kind of one thing I would say that we're really focusing on with a lot of clients currently.
Yeah, thank you. Karen,
Hmm.
has the ability to use a self-directed IRA changed the way investors can build wealth through real estate and alternative investments?
Change. I mean, do you know that the self-directed IRA is 51 years old?
Hmm.
Is that crazy? Yeah,
Yeah.
it kind of blows everybody's mind. I think it came to the forefront really in the Great Recession, when people were looking for capital and you couldn't find capital, and suddenly realized you've always been able to self-direct an IRA. So I think it does. I think the fact that self-directed IRAs are out there and that we're talking about them more since that time has opened doors and opportunities for people to look at alternatives for their retirement, which they really weren't doing before. So I would say yes in that regard. I mean, it's always been there, but I think the awareness has really, really grown.
Now, didn't you say something earlier before we got started that there's some bills right now that
Yeah.
people are trying to make some changes around it? What's going on with that?
Well, I'll just say this much. I mean, it's early days, but so 3 Republican senators decided to get on board and create a proposal. And the proposal is to eliminate prohibited transactions from self-directed IRAs. And it's called the Smart Savings Act of 2026, if you want to look it up, the Smart Savings Act. So it's a proposal. And so we'll see what this changes, but a prohibited transaction can nullify or hurt your self-directed IRA. You can lose the tax protected bubble of your self-directed IRA if your IRA commits one of these prohibited transactions. So this act would say pretty much anything that's a prohibited transaction now wouldn't be, except for living in a property that your IRA owns. So, just you can watch this as it goes forward. It's newly proposed. My experience is that proposals are out there for a very, very long time before anything happens, but it's crazy that this is being discussed. Prohibited transactions have been there since 1975 when IRAs were created pretty much. So it's really a departure from what our industry has always, the guidelines, the guardrails that we've always had.
Yeah, interesting. Paul Travis, this is kind of directed to you guys, but when you're evaluating a real estate deal today, and I know that we all look at different asset classes, but when evaluating a real estate investment today, what are the 3 things that you believe that investors should be looking at that they may be overlooking in their investing journey?
Sure. Paul, you want to start on it?
Okay, I can. They say location, location, location. I would say sponsor, sponsor, sponsor. Um, I think that they should, if you're a passive investor, I think Karin mentioned earlier, it's not really passive. Well, the way you can make it the best experience possible is really, really looking very, very closely at the sponsor. And then the 3 things, I mean, we have a 27-point due diligence checklist we have available for people and that we use internally. And, we look at things like number of years doing this asset type. We look at what type of debt they use in detail. I mean, we look in the covenants and everything. And then we look how much skin in the game the operator has. And there's 23 or 24 other things, but that's some, I mean, I would really, really spend a lot of time with the sponsor. A great sponsor can turn around a mediocre asset, but a bad sponsor can ruin the best asset in America.
Interesting. Travis?
Yeah, my framework really hasn't changed over the last decade. It mostly aligns with what Paul just said. So, number one to me is a sponsor for the reasons that he pointed out. I would go a step further in 26 though, and I would ask a lot of questions about their current portfolio and what's been happening in the last 5 years. Do they have distress on the books? And it's okay if they do. It's just kind of like feeling out where they stand here because you want to make sure these deals are illiquid, right? You could be in a deal 5 years, 10 years. You want to make sure that operator's going to be around in 10 years before you go place capital. It's pretty important. And also, out of my personal experience, I always put the market a second because I have honestly invested with like pretty bad operators, especially early on. I would say this is just my opinion, not going to name names, of course. But the market carried the deal. It just carried the deal. They messed up nearly everything they could have messed up, and we made a profit. And it goes both ways on that. You know what I mean? And so back to like the deal is last. The deal is last because you want to put all the experience in the market in the front running seats, to help you, statistically improve your odds of a positive outcome. So a good, reputable sponsor and experienced individual is going to know what kind of debt to put on a deal, and what kind of leverage to use, right? And why that, and like what Paul's talking about a due diligence checklist. I mean, they're going to have systems, processes, and hopefully a good track record to back this stuff up. So yeah, you could buy a great deal at a great price and lever it up to 90% leverage, hit a downturn and lose all your money. I mean, it's pretty simple to do that. So that's my order. So it's the sponsor, it's the market, and then it's the deal last. Those are my top three.
Well, to what both of you guys have said, I always say that I don't think that there's any geniuses in this business. There's just market cycles. And, as you said, Travis, you could be a bad sponsor, catch the wind at your back and do very well. You could be a great sponsor and catch the wind in your face and not do as well. So
and by the way, one last thing on that, this isn't like a point the finger blame game. Like when I did single family homes, I remember this house I bought in like 2012, which was a fantastic time, it turns out. But I screwed everything up. I was trying to rent this house out, and I mean, I was over budget. I was doing the wrong things, and I got someone in there that didn't pay, and like they trashed my house. I replaced the carpet twice. Like it was a total mess. And I made about like 25 grand in about 13 months, which is not impressive. That's not why I'm sharing. I'm just saying I was naive and stupid as hell, but that market carried me. So it does matter.
Hey, Karin, there's a question in the chat from Renee, and they're asking, are all companies who hold self-directed IRAs subject to the same limitations? The company I am with has told me my dollar has to be the only funding source for the property completely with no benefit to me. I.e., all the expenses must be paid through the IRA and income goes to the IRA only.
Yeah, that's 100% true for everyone, for every self-directed IRA, even not self-directed IRA. One of the prohibited transactions, if you want to look it up, it's, I'll type it in here where it's written. IRC is the Internal Revenue Code 4975. If you like rule books, hang on, 4975. There we go. There it is.
That's like 10,000 pages, right?
Yeah, it is a little light reading, but there's also another one called Pub 590. You go to irs.gov and look up publication 590. It just really breaks it down about what these rules are. But yes, so you're not allowed to have personal benefit, present benefit, indirect benefit from your IRA today. IRAs are 100% about later. You get this tax benefit so that you will have money later. So you're not benefiting today, you're saving it for later. And the government wants to encourage that. And that's the reason for the rules. But it's true universally, regardless of what self-directed IRA company it is. These are federal rules.
Awesome. Hey, Jeff, I have a question for you. So there's been some chatter lately, especially social media, which could be fake news, who knows? But there's been chatter lately that the stock market's overinflated. that there's no substance to some of the returns that are performing with, some companies. What's your feeling around that, or what's your thoughts around that? Is the stock market overinflated? Is it going to continue to go up as it's gone up? Because in here's why I asked the question. In our world, what Paul does, what Travis does, what I do, in our world, most new investors don't come into alternatives until the stock market starts to experience some painful growth, right? Or default. So can you talk to that a little bit?
Yeah, absolutely. I mean, I think, when we look at hitting record highs and again, looking at some of the, price to earnings ratio of some of these companies, I think you have to say that some of that is fair, right? It's a fair point to say some of that. I think, again, just trying to use kind of real world examples we've been dealing with, like SpaceX is a great example when it comes out and has its IPO. And we're saying when we look at what the revenue is, right, what the profit is from this organization and what the valuation of it is today, they don't appear to necessarily be in line. And so a lot of something like that is people being excited for that, people wanting to put their money into it. I mean, how many of my clients reached out, haven't talked to them in whatever, a few months, and all of a sudden it's like, hey, should we look at this SpaceX IPO? It becomes a big question. And so, I think there are some companies out there like that, and when they're that large of companies, when they're when they're that much money involved in these, I definitely think there's pieces to that. The other thing, though, that I do share with a lot of my clients, the ones that are a little more nervous about maybe where things are at and having some of those concerns, seeing these things on TikTok or Instagram, when we sit down and go through the review of their portfolio, one thing I've done too is really just kind of pull up the stock market, pull up the chart, over the last 20 years. And when you walk through and see the dips, in the stock market that we have had, even if I just go back to, 2018 often, it's like 2018 fourth quarter, we had a significant drop off in the fourth quarter because of some of the tariff stuff going on with China. We, of course, had the pandemic hit in 2020. 2022, we saw another, significant drop off. And these might not be the 2008, 2009 recession drops that we saw, not only that significant, but for that long of a period. But we really have seen some of these pullbacks in the market of 20%, fairly often over the past so many years. The market has just been fairly resilient to get through those pretty quickly. I do think some of that is, inflation's been a big topic. There is a lot of people making a lot of money, and a lot of people have more information now than they've ever had about getting into the stock market and investing their money. And so I was reading something the other day, and I don't have the stat in front of me, but the amount of money that is being put into the market from kind of your retail investors, not your your large company, not your big funds putting money into the market, is significant. It's quite a bit different than 50 years ago. It was really only certain people putting money into the market, whereas today there are so many different apps, so many different platforms. Robinhood. I know there's multiple other ones where people can invest into the market with the change that they have left over from going to McDonald's. There's 70 cents extra, and they can send it directly into their brokerage account that invests in the stock market. So I do think because of some of those things, although it might appear a little inflated at times, I do think it's going to be a more resilient market than we've seen in the past because of that ability for your everyday retail investors to be able to invest in the market.
Yeah, and you kind of opened a door for another question, right? So, and I'll let you think about this, but so with where the world's at right now, and not to get political, but with the war going on, the rising cost in gas prices, the interest rates being high, the uncertainty that's out there. Do you think we're at the bottom? Are we at the bottom? Have we reached the bottom? Are we, where are we at in the cycle? Paul, and I want to start with you.
Yeah, I don't mean to keep quoting Buffett, but he and Charlie Munger and Howard Marks all say you can't really see the bottom except in a rear view mirror, and you can never see it through your windshield. And I just don't know. I really don't. Um, the who said it? Who was the Fidelity? Jeff, who's the Fidelity Magellan guy? Peter Lynch, right?
Peter.
He said that those who live by a crystal ball are destined to eat glass. And so I'm just gonna punt on this one, Mike. Sorry.
Travis, any comments?
So you're asking, just to clarify, in commercial or in a specific asset class or stock market? What are we talking about?
Yeah, I'm really thinking more on the real estate realm, right?
Yeah. Yeah.
Here's the thing, right? So a year ago, I was saying we're at the bottom. I think we're going to come out. And I thought 2026 would be a totally different year. And it
Sure.
hasn't been, right?
Yeah.
And so where are we in this market cycle?
Yeah. Well, here's what I can, again, I respect kind of the Buffett, the Munger, and to Paul's point, I mean, I don't have the crystal ball, but what I can look at, what anyone can look at, and especially with the public markets, is, the historics. Like I was watching this video the other day, just even though I don't play in this asset class, but I was watching the 4-year cycles of like crypto. And it's just, it's never a promise or a guarantee or a certainty, but it's like, you could look at every 4 years, these drawdowns, in the early years of crypto had these huge 90% pullbacks, and it was like 80, and then it was like 70. And so now some people are saying maybe it'll be 60. Nobody knows, but it's somewhat helpful to just kind of know that in midterm years, we have a bear market typically in crypto, and that it could fall, 50 to 75% or whatever. So not financial advice, but that's just, you can do that with real estate or anything else. And I've thought a lot about this because the critical error that I made in 21 and 22 was failing to recognize the macro cycles of real estate. And I had just literally gone through a decade of making a ton of money in real estate. And a cycle is typically 10 years, give or take. Again, is it going to be 8? I don't know. Is it going to be 12? Maybe. But we were already at 10. And here I am saying, okay, here's my money to tie up for 5 more years. That's pretty dicey. You know what I mean? Like you're basically going against history. You're saying, I feel different. This bull market's going to continue chugging along. And, I lost a lot of money off of that. So I think it's worth looking at cycles and kind of where we're at. And stocks are pretty hard nowadays because the world's changing so fast and they move so rapidly. And, to Jeff's point about SpaceX and that multiple on that thing is just crazy. But here's something that might be helpful to the audience that I think about with stocks is if the S&P, and I'm just making these stats up because I don't really know, but if the S&P has a PE of like 28, price to earnings, then it takes $28 to basically buy $1 of profit, in the market. And to me, that's pretty high because when I look at things like, to pick on self-storage or whatever, it's more like maybe $16, $17 for $1 of profit. So point is, not to go down a rabbit hole or get in the weeds about that, but I'm always looking at where is there more opportunity? Where have prices already fallen? Am I comfortable at this point that just like when I bought in 2009, I didn't time that perfectly. I bought a piece of real estate and it continued to decline. And then I sold it in about 2012 and I made a pretty good profit. So I think that was to Karen's point, or whoever said it, but hold on, be a long-term investor.
Mm-hmm.
I get so tired of speculation stuff and trading crap and what's the S&P going to do tomorrow? Who fucking cares? So anyway.
Yeah, well, that reflects back on the Warren Buffett, Charlie Munger comment,
Yeah, there you go. So that's probably it.
Karen, any thoughts on that?
Well, I just have to say that I have a different thought, and that is to say that one thing I'm seeing in the market is people are saying, "Where's the capital going?" And how do I find capital? Or I'm having trouble raising capital, and I just want to point out that the retirement industry as a whole represents $49.1 trillion of retirement savings. Okay, so if you can tap into that for your capital raise, it's there. And all you have to do is say, hey, do you have an IRA or do you have a 401k with a previous company? And if you're raising capital, you're the GP, you're raising capital, there's plenty of money to be found for a good deal, you know? And hopefully the investor vets it correctly, like we've all discussed today, but there's no lack of capital.
Yeah, that's for sure. Jeff, how about you?
Yeah, I mean, to echo everyone's, I think there's no crystal ball to know exactly where we're at. And, you see a lot of trends similar to the stock market, to the real estate market. I would just say, I guess, share, one of my concerns or things that I look at, and not something I necessarily tell clients about, but just as I'm trying to be aware of things that are going on in the world. Like I said, inflation's been such a big topic of conversation the past few years. And I think just looking at, the price of goods, price of everything compared to, raising income levels, that to me just, it feels like things are not going to continue to last as long as they are. Again, the AI stuff, and you're seeing some of the jobs cut from that. That doesn't really concern me much. I just feel like, when one door closes for a particular job, a new job is going to be created that's going to be needed for us. But I do just think, yeah, the price of some of the goods compared to, salaries that people are living on, that has gotten to a point that's pretty unrealistic. And so I do expect, something to change there, and how that changes, and what that looks like. I have no clue. And whether that's already happening or it happens in the future, I'm not sure. But oftentimes, we have to go through these different cycles, and things kind of have to get a little out of whack, as I tell our clients. Things have to kind of get that way to get them reset and get back. And, that's just one thing that I hear a lot from, our everyday people out in the world, spending money, buying groceries, buying these different things, and trying to, keep up, with distributions, keep up with their income. So I'm curious, I guess, even more so than concerned, but curious to see how that kind of plays out. And like I said, if we're in the midst of seeing it, or if it's behind, I'm not sure. But that is something I'm curious to see how it evens out a little bit more.
Yeah, I believe it's hard to read, but I also believe that, there's that old Chinese proverb that, there's 2 times in your life you can plant a tree.
All right.
One was 20 years ago and one is today. So, you choose, right? Okay, so I kind of want to start to land the plane on this last question, and kind of twofold. If you were going to give an investor advice today, or one of the investors that's listening in today, about positioning their capital for the next 3 to 5 to 10 years, what type of advice would you give that individual? Take your deal out of it, anything you do, what kind of advice would you give to those investors? Travis, why don't you jump in?
Sure. I've spent a lot of time, because, this is my personal and professional life centers around investing. You know what I mean? So I've taken a tremendous amount of time to try to get all this stuff right. And very few times am I always right on stuff. You know what I mean? I've made a ton of mistakes, like all of us, and I just don't have the answers. I can tell you dozens of deals that I vetted that I said, this is going to be a fantastic deal, and it underperformed. And then I saw a deal that I thought, it's okay. It might, I'll just diversify. And then I doubled my money on it. It's like, damn, why didn't I put way more into that? So DCA, the dollar cost average, as I always do, and take your time and be patient. Start with education always, and take more time than you think you need too. Don't just listen to 5 podcasts and go put all your net worth to work. Take some time, take 6, 12 months, whatever, because the last thing you want to do is go into something illiquid for 5, 10 years and regret it, a year in, and a lot of us are in that spot with certain deals. And diversify, diversify, dollar cost average, investor education. Those are my top ones.
Mm-hmm.
Great. Thank you. How about you, Jeff?
That's hard to add too much more to Travis. I was going to already say, just listen to a lot of things that he's already said so far. But yeah, I really agree. I think those top 2 are exactly what we would talk about, right? Diversification is huge. Again, we don't do a whole lot of the alternative investing here with us. We don't do a lot of the real estate stuff outside of there. But I tell my clients all the time that it's important to add those things into the portfolio. And so I might not be the person who's going to do all those deals and help with it, but I think we should find a piece of the portfolio, a sliver, to do that. So diversification is huge. The dollar cost averaging, as we've talked about, right? I think not putting all your eggs in one basket at one time, but just continually doing it. And that kind of leads really to the last point I would just add is having that plan. Stick to that plan. If you put a plan in place that is at least conservative in nature by the sense that you are diversifying, you are doing it at regular intervals, right? You stick to that plan. It takes the emotional side of things out of it. That's the biggest thing we see with our clients and our investors is, with market cycles and the way things go, emotions end up playing a huge part in this, being that it's a lot of their life savings that we're dealing with. And when we have a plan in place, when we can sit down with our client and go back to the plan, say, this was the plan, this was how it was, this is how it's going to play out. We expect volatility in the market. We expect these different things. We are sticking to the plan, and this is going to play out for us long term. It takes all those emotions out of play. It takes all the bad decision making out. We stick to that plan, and that's really, what we need to do with our clients.
Yeah. Yeah. Thank you. Karin?
Yeah, I mean, of course, again, you guys have all hit on the key points about succeeding in investing. One of the things that I started thinking at one point in my career was, wait a minute, if I'm in the retirement industry, how am I going to retire? What is that going to look like? So I thought, well, all right. So where do you start? So we all kind of start with like Social Security, right? I mean, that's something that we all sort of have. Then we maybe have like a little money in the bank or some cash. Then we have our retirement accounts, be they self-directed or not 401k. So it's kind of like building a layer cake. Now on top of that, maybe you've got life insurance, like whole cash value of whole life, or maybe you've got an annuity. So it's just to diversify. And then maybe you've got some rental properties or some of these alternative assets that we've all discussed today. But each one of them is a building block, because pre-retirement, what we want to have, I mean, ideally, is multiple streams of income. So we're not just dependent on one thing. And since we have time to plan for retirement, I think that's the thing we have to plan for too, is multiple streams of income, because when we're in retirement, we're not going to be able to pivot on a dime and just go earn more money or something like that. We have to, diversify enough, like everyone has said here, so that if there is some black swan, something blows up, we have so many layers of different kinds of income that we can make it through, make make it through to to the end. So yeah.
Yeah, that very true. Thank you. How about you, Paul?
Yeah, so one thing I would say is I would definitely recommend diversification, no matter how good a deal looks. Like Travis said, something could go wrong. And I mean, I think our biggest risk in private placements is fraud, which is another reason we need to really be as careful as we can with the operator, the sponsor. But I'm also going to take off on something else Travis said, and that is, right now, the PE ratio in equities is extremely significantly higher than in real estate. And I was hoping I could show a slide. So I got two slides here. That first slide I just put in the chat shows that it's 3 times more expensive right now to buy equities. If this chart's right, CBRE put it out. That first chart says it's 3 times more expensive, PE ratio wise, to buy equities right now than real estate. Does that mean real estate is undervalued and stocks are overvalued? I don't know. But it looks like, according to this chart, that it might be a good time to look at being in real estate. The second chart shows an amazing statistic, and that's the Brookings Institute, who follows housing really carefully, saying that there's a 5.9 million unit shortfall in housing right now. That's single and multifamily. But it's going to it looks like it says 9.6 within 9 years. 9.6 million shortfall. This was like zero shortfall, by the way, around 2007. That gap's never closed if these numbers are right, and it seems to be getting wider. So I would say, consider investing in real estate, consider investing in affordable housing. To me, that would be mobile home parks, affordable apartments, and affordable homes. I don't know any 20 somethings who want to be a general contractor and want to build. And that's just it seems like that'll just continue to widen the gap in the coming years.
Yeah, awesome. Great perspective, that's for sure. One last, Karen, can you take a look at that question in the chat from Ed?
Sure,
He's looking
sure.
for
I'm
more.
looking for, oh, I'm sorry. Yeah. I'm looking for more cash flow for self-directed IRA. Is there any way to obtain the distributions, or do they always go back to the IRA where I have a taxable event when I need to pull the funds? Yes. When you put money, when you make a contribution into an IRA, if it's either you get a tax break, like say a traditional account, or maybe a SEP, and a Roth, you pay the tax and the money can come out tax-free. But then taking it out was going to be most always a taxable distribution to you. So yes, yes. And that includes the Roth is a little bit different though. With the Roth IRA, you already paid the tax. So contributions can come out. You already paid the tax. So you can take Roth contributions out and so forth. And of course, once you hit 59 and a half, if you've had a Roth for 5 years, then everything within a Roth can come out to you tax-free. So there are ways in which you can take distributions that are not taxable. But that's kind of the price you pay for saving for retirement is that there's kind of a sting. The government is trying to encourage us to save money for the future. And that's the sting, that if you're going to take the money out most of the time in a pre-tax account, you're going to pay tax if you take it out.
So here would be my question around that, right? Because I've talked to Ed a little bit and I kind of know what he might be looking for.
Yeah.
But if he made an investment that was strictly a cash flowing investment where he had no depreciation, no way to take any losses, and no equity in a deal, if he made that investment through his self-directed IRA and then took the cash flow from the returns, put it back in his IRA. If he's older than 59 and a half, he could pull that cash flow back out of the IRA and it would be tax-free?
No.
It wouldn't
No.
be.
No, it would not be. Yeah. No.
Okay. I thought you said at 59 and a half, you can do distributions.
With a Roth IRA?
Yeah.
You sure can. So for a Roth IRA to be tax-free, you have to meet 2 conditions. One, you have to have had a Roth IRA for 5 years and you have to be 59 and a half. And if you meet those 2 conditions at 59 and a half with a Roth, then the money comes out tax-free for life, which is pretty cool. I mean, the Roth IRA really is the brass ring. And another thing that a lot of people don't know about the Roth IRA is that Secure Act 2.0 that was approved in, get this, the end of 2022, allowed Roth contributions to SEP IRAs. So if you're self-employed, you have a SEP, which is a self-employment plan, basically, you can, and you've got a contribution cap of 73,000, the most you could possibly put in. If you meet the qualifications to make that kind of cap, it could be all Roth dollars you put in there. So you pay the tax on it, stick it in the Roth bucket of a SEP, and enjoy that tax-free gain. But I'll tell you what, it's been, like I mentioned, the end of 2022. The Department of Treasury still hasn't come up with enough guidance, like proper guidance for that. Jeff's smiling. Like we literally, I'm on the board for the RITA, the Retirement Industry Trust Association. We had this panel in March in DC. The attorneys for the IRS are looking at us and saying, I know, we haven't given you guidance, I know. And I know what you want, we don't have it yet. So they know that we need it, but gosh, I mean, hi, knock, knock, it's been almost 4 years. So we're looking for guidance, but the SEP, you can make Roth contributions to SEP IRAs. Who knew?
Yeah, well, I promised I wouldn't get political, but that's the wheels of our government. So,
but I'll tell you what, I mean, you're right. And at the same time, what I've seen happily through this whole process is that both sides of the fence are equally supportive of retirement savings. No one's anti-retirement savings. Now they don't like the multi-million-dollar retirement accounts. That's one thing, like the Peter Thiels with their Roths. But for the average Joe, every single member of Congress that I've seen has been in favor of retirement accounts and saving, and they're all pro retirement savings.
Yeah. All right. Well, thank you. I appreciate you guys for participating today. I appreciate the audience for being here and listening in. Why doesn't everybody give your contact information, let people know how they can get a hold of you, and maybe if you have a last comment for anyone. Jeff, why don't we start with you?
Yeah, no, I just want to say thank you for having me today. This was excellent. I appreciate everybody spending time with us, listening in, all the great questions here. Yeah, I think, like I said, when it comes to investing and deploying capital, I think we've touched on this quite a few times. But yeah, I think just have a plan in place. Consider dollar cost averaging into stuff, and diversification is huge. I think those are the top things we talk to our clients about. I think if you do that, you're not going to be upset with yourself down the road.
Yeah. Awesome. How do people get a hold of you, Jeff?
Let me throw this into the chat here real quick for you.
Karen, you want to go?
Yeah. The way to get a hold of us is our website. It's the letter U, udirectira.com. We're all over social media, so hit us up on like Instagram, for example. I do a lot of talking head videos that talk about, there's so many different parts to self-directed IRAs. To talk about the whole beast is a lot, so it's just a little snippet at a time. But again, we're all over social media and udirectira.com. I threw a link in there to a free report to learn about alternative assets.
Thank you. Paul?
Yeah, my contacts information is in there. My final comment to the audience is, as you get older like me, you'll realize the value of leaving a mark on society. Right now, if you took the record profits of ExxonMobil, Nike, and Walmart, and you added those record profits together, you'd come up with the annual profitability of human trafficking. It is a tragedy, and we're doing everything we can to raise money at Wellings Capital to fight human trafficking and rescue its victims. And you can, I was wrong. You triple that number, and that's the approximate profitability of human trafficking every year. And so if you want to learn more, I'll put the website in there of an organization we support and we're very passionate about.
That's awesome.
Thank you. Thanks for that. Travis?
Hey, thanks everybody. I put my LinkedIn in the chat. There's obviously many ways you can reach me. You can just search me, and if you want to do a call or whatever, but I'm active on LinkedIn. I post a lot of stuff there, so be happy to connect. If you want to do a call, let's do a call. I'm investing all the time every year, so I'm really here just to support other passive investors and LPs, and open to discussing any asset class with any firm and any questions that you have. So thanks so much for having me again. Appreciate it, as always.
And thank you for being here. Karen, thank you.
Thank
Appreciate
you.
your time as always. Paul, thank you very much. Travis, thank you. And Jeff, thanks for jumping in at the last minute and filling in. Appreciate you. Tell Chad that he owes me one. So
I will tell him.
Yeah. And I just want the audience to know, thank you for being here. We'll be back in September with another great panel. If I can answer any questions or do anything, don't hesitate to reach out to me personally. And as Karen said, you can find me on social media. Wherever you hang out, I'm probably there. So thanks, everyone. Have a great evening. We'll talk soon. Bye.
Thanks.
Thanks.